Hello friends, and welcome to Looking at the Markets with David Modell. Want to talk about moving average crossover strategies, where you have two moving averages on the chart. And this is mainly for swing traders, but you could also apply this to day trading if you can make some adjustments. All right, so let's say you like to use a moving average crossover strategy. It's very popular. You put up a faster moving average and a slower moving average, and you can buy when the faster moving average crosses above the slower moving average. And then you can hold onto it and then don't sell until the faster moving average crosses below the slower moving average. That's your basic moving average crossover strategy. But what two moving averages do you use? Should you use simple or exponential? And what two numbers? What two look back periods? All right. So this is an article, and I'll put the link to this article in the description below this video in case you want to read it. And it is not the 50 and the 200 day moving average. Okay, there was a study that they did according to this article, and supposedly, according to the study in this article, the good old-fashioned 50 moving average and 200 period moving average is not the best combination. It might be one of the most popular combinations, but supposedly, according to this study, it's not the best one. All right, so, and this is from Yahoo Finance and Benzinga. Wanted to give them credit. All right, so here's the 50 and 200, and okay, not the best, supposedly, according to this study. All right, so, and they talk about the 50 and the 200. All right, so they used in this study here 300 years worth of daily and weekly data from 16 different global indices to determine which two moving averages would have produced the largest gains for crossover trades. So they crunched a lot of years worth of data here, and so I have to give them credit for that. All right, and also I want to give credit to whoever did this study. It is from ETF HQ. ETF HQ. All right, they conducted the study. And all right, first of all, this is interesting. ETF HQ found that exponential moving averages, EMAs, performed better overall than SMAs, simple moving averages. So I thought that's interesting. Okay. I found them to be pretty similar in performance. Maybe for day traders, there's more of a marked difference between the EMAs and the SMAs. But for long-term and swing trading and that kind of thing, I found them to be pretty similar most of the time. But hey, they crunched the numbers, and they found that EMAs are generally overall better than SMAs. Okay, so which two EMAs did they choose as the best ones? Here it is. Among short and long-term EMAs, they discovered that trading the crossovers of the 13-day and the 48.5-day averages produced the largest returns. So the 13-day EMA and the 48.5 or 48.5-day EMA. That's the big winner, according to this study here. If you can even put 48.5 day, the moving average on your chart, if your charting software allows for that. If not, then you'll just have to put 48 or 49, I suppose. All right, so, and they put a little chart here. The pink line, this represents three different strategies and the performance of it over a period of years. The pink line, that's the 13 and 48.5 moving EMA, moving average crossover, that they found to be the best, and you can see it performed the best. And then the second best is the 50 and the 200, the good old classic there, moving EMA, moving average crossover strategy. And then the one that did the worst out of the three strategies here, the one that did the worst is the blue line here, dark blue, which is just buy and hold of the index. All right, so supposedly that one did the best. So let's see what that looks like. All right, so I just went to stockcharts.com and I entered SPY, the daily candlestick chart for this is a fund, an ETF that tracks the S&P 500. And first I put in the 50 and the 200 EMAs. This is a 50, the faster moving one. and this is the slower moving one, the 200-day exponential moving average. And there's been, looks like the makings of a correction here. Some seriously big red candles here. So you'd think this would take you out, yeah, because if you had profited all the way up, this would be a great time to take profits so you don't lose it all, right? But with this 50 and 200, you're waiting for the death cross, right? The good old death cross where the 50 crosses below the 200. But the 50 moves so slowly. I mean, it barely even turned around here. You've got some serious bleeding in the markets, and you want to be taken out, but this isn't even close. The 50 and the 200 are still way far apart. Therefore, it's possible for a lot more red, a lot more bleeding to occur. You could lose a lot of money before this one finally crosses below that one. So maybe it's not that great. All right, the 50 and the 200. So let's see what they recommend. Stockcharts.com. I don't think I was able to put in the 48.5. I tried it, and it just did 48, so that's fine. So I put in the 13 and the 48, and look at that. As soon as trouble started, it took you right out. That 13 crossed below the 48. Bam. All right. So, it crossed above here, and you would have enjoyed all this ride. It almost crossed, but it didn't. So you would have enjoyed all this ride up here. And then as soon as these consecutive big red candles happened, you want to be taken out so you don't have to end up down here, practically starting all over and losing months of gains. As soon as trouble started, bam, you're out. So it makes sense, at least in this one example, okay? Because you want to be taken out as soon as real trouble starts. As soon as you get those consecutive big red candles, a good moving average system should take you out so you can lock in those profits early that you enjoyed and that you spent so much time gaining it. They say stairs up, elevator down, right? Okay. So there it is, according to this article. Check the link in the description below this video if you want to read the whole article. But I gave you the gist of it. You could try it out, see if you like it as a swing trader. Maybe try it as a day trader. You might like it, all right? But make your own decisions. Don't do something just because an article told you to do it or just because I told you or anybody told you, all right? Cool. You like this video? Hey, give it a thumbs up. Why not? And leave a comment. What do you think of this strategy? Or what are your favorite moving averages? And subscribe to my channel. You haven't subscribed yet? What? Come on now. You got to subscribe and hit that notification bell on YouTube so you can get notifications whenever I put out a new video. And if you want some help putting together a trading or investing plan, you can email me anytime. davidmodell@gmail.com is my email address if you want more assistance with this. Thank you so much. I'll talk to you again soon.